Well, every career can have several chapters. Our next guest has had enough adventures to write quite a business book. After a long and successful run at Goldman Sachs, he went on to run the New York Stock Exchange. These days, he's far from the trading floor and instead spending time at the soccer field running Venezia, the professional team in Venice. But he is also quite busy as a managing partner with the wealth management firm Transcend Capital Advisors. Duncan Niederauer joins us now to talk a little bit more about the markets and the business of sports. Duncan, nice to have you with us.
Nice to be with you, John. Thank you.
I guess before we talk a little bit more broadly about the markets these days, for this transition into the business of sports, maybe you can remind us how this all came together for you.
Yeah, I think as a lot of us were focusing on a few years ago, I think sports has emerged as an asset class in the world in the last 5 to 10 years. If you think back to a few years ago, really the only transactions were teams being sold in the major leagues here in the U.S. between billionaires. And now I think what people have realized is with all the tailwinds around media rights and wagering and sponsorships and the ability to build global brands and platforms, I don't think it should surprise anybody that sports has emerged as an asset class that a lot more people are looking at. So my first adventure was dipping my toe in the water with the Vegas Golden Knights as a very small minority investor. And then a group of us acquired the team in Venice in early 2020 in Venice, Italy.
So there you go. And, these days, I think for a lot of investors, whether it's getting exposure to new asset classes or sticking with the traditional stock market like the world you oversaw at the NYSE for so many years, it feels like more open doors for investors than there would have been in the past. How are you thinking about, the idea of creating a portfolio that addresses all of that?
Right. It's a great question. In fact, when we founded Transcend in 2019, our primary hypothesis was that clients deserve to have access to the same type of investments that the largest and most sophisticated institutions and endowments did, and we didn't see why they couldn't. We loved the idea that being independent comes with being a fiduciary, so you bring that mindset to work every day. And if you're going to invest like the best institutions do, you're going to have a very diversified portfolio, and you're going to have to introduce non-correlated asset classes into the mix. I think sports is one of many uncorrelated asset classes, but we spend a lot of our time helping our clients get what we think is a portfolio built for the long term. We think portfolio construction matters a lot. And you need to look no further than last year when those traditional asset classes you were talking about didn't exactly deliver great returns.
And would you say that there has been an evolution in the ability to trade within those, I don't want to call them alternative asset classes, but you spent a lot of time trying to make it very accessible, the traditional stock market. Have we seen an evolution maybe through technology in some of these other asset classes as well?
Yeah, I think not just in technology, John. I think really across the board. If you have access to the asset classes, you have access to the right managers, which I think we're blessed to have, thanks to the networks my partners and I have. I think it's become increasingly easier and accessible to get into that alts world, right? Whenever we use that word, everyone kind of gets scared. Everyone thinks it's these illiquid assets that no one can access. It's just fundamentally not true. We've been able to get access to the private credit markets. We've been able to get access to the reinsurance markets. I think it's easier than it's ever been to get access to these asset classes, yes.
Okay, and then the other factor out there, which actually sparks a conversation around different asset classes, is the current interest rate environment. And everybody's trying to figure out when we might see an end to this current rate hike cycle. But very few people are saying that overnight we're going to see rates go back to where they were before this rate hike cycle began. How does the current interest rate environment inform your thinking around sort of investing and the conversations you're having on that as well?
Sure. Well, we don't try to get into the business of speculating what the Fed and Chairman Powell are going to do next. I would say we're not quite so sure that we agree with what you just outlined. We know a lot of people see it reversing course. When we read what they're saying, it seems to me that they if I'm reading it correctly, they seem to be suggesting that they think it's riskier to stop and go in reverse than to continue to do what they've been doing. So we think rates are going to be pretty sticky in the near term. My personal opinion and our firm's view is that you've seen a 500 basis point increase pretty quickly. And I think we're actually underestimating what the longer term impact of all that's going to be. So if it were up to us, I think we'd hope that they would hit pause on further rate increases, keep an eye on inflation. If it continues to abate, I think there's no reason to do any more. And if we see some signs that maybe the labor market's tighter than we all think it is, okay, sure. But I think we'd take the pause that refreshes right here if it were up to us.
Okay, Duncan, before I let you go,
Sure.
I mentioned the start at Goldman, the career on Wall Street, adding sports to the mix, and wealth management these days as well. For those who are always curious about trying something new in their career, even if they've had success in a particular area, any lessons for people who are maybe looking to broaden their reach?
Yeah, don't be afraid. I thought I had a lot of experience I could draw on from my career. I felt very lucky to have the career I had on Wall Street. And I thought that this chapter of my life gave me the opportunity to try to apply some of those lessons that I learned in fields that maybe I wasn't as familiar with. Wealth management being one, investing in sports being another, things I was always interested in having an impact on, but really didn't have the time or capacity to do it in the formal part of my career. So don't be afraid. There's a lot of new opportunities out there. Give them a try.
Okay. Duncan, great to have you with us. Nice to see you. Thanks for the time. Appreciate it.
Great to see you again, John. Be well. Thank you.
Welcome back. The federal government released draft regulations last week to make Canada's electricity systems net zero by 2035. The plan is to use about $40 billion in new tax credits and other investments to aid provinces and territories with greening their power grids. While environmental groups are applauding the new regulations, both Alberta and Saskatchewan have balked at the pace of the expected change, with Alberta Premier Danielle Smith claiming that her province, which relies on fossil fuels for about 89% of its electricity, will never comply with the plan. Yet, the Canadian Climate Institute points out that those provinces are the ones with the most to gain from this transition. For more, we're joined by Dale Buyugin, Executive Vice President of the Canadian Climate Institute. Welcome to the show, Dale. Let's start out with, how do these clean electricity regulations align with our broader G7 commitment to decarbonize the power sector by 2035?
Well, they align really well. I mean, all of our G7 allies have committed to the same target. They committed to a net zero electricity system by 2035, just like these regulations require. And for good reason. It is clearly on the path to net zero, which all of those countries are trying to achieve. It makes sense for affordability of power, and it makes sense for competitiveness.
Well, when we think about tax credits and financing sources, this is usually something that helps spur the private sector's interest in moving into this kind of sector. What opportunities are you seeing for business and industry?
Well, almost all the pathways to net zero for Canada require an electricity system that is bigger, cleaner, and smarter. So it has to grow by 2 to 3 times. So that is a huge amount of investment and possible sources of economic growth that are still consistent with Canada's climate objectives and net zero. To achieve those targets, we need to support that electricity system and make sure that those systems can grow in a way that is clean. That's increasingly important for attracting capital. We're seeing in Alberta, Amazon made big investments conditional on availability of clean electricity. We're seeing big investments in battery life cycle, battery supply chain investments in Ontario. Again, all of those investments citing the availability of clean power as being a key opportunity that has driving that capital attraction. So it's a big factor. It matters for competitiveness. It matters for keeping up with the rest of the world that is trying to make the same claim.
Now, we know wind and solar aren't always as cost competitive as they need to be, but they're getting there. What does the economic future look like for natural gas-fired power in provinces like here in Alberta and Ontario?
Well, really important that there's some flexibility in these regulations. It is not putting an absolute stop to all natural gas-powered electricity right away. There's an off-ramp for existing facilities. They can continue to operate for 20 years. There's an opportunity to use carbon capture and storage on natural gas-powered electricity. So it's, again, not renewables only. It is net zero regulations. And if they can capture those emissions, that'll comply. Even still, there's still allowances for emergency use of natural gas in really peak demand periods. So the future is clean, but that doesn't mean just renewables necessarily.
Now, we know Alberta plays a really pivotal role here. We've seen our premier in this province saying that she's putting a pause when it comes to renewable energy projects. You know, what is that lack of traction in this province? How big of an impact is that going to have on Canada's overall clean energy goals?
Well, it's a step backwards for Alberta. I think it's worth just saying that directly. I mean, Alberta has some of the best wind and solar resources in the country. They were on track to attract billions of dollars in investment by 2023 in wind and solar. And this is a signal that there is market uncertainty. That being said, it's pretty clear that the federal government does have jurisdiction on emissions, a shared jurisdiction with the provinces. So it is. I'd be surprised if firms in Alberta are not going to be paying close attention to federal regulations, irrespective of the rhetoric from Edmonton.
You know, what should the federal government do when it comes to provinces that are opposing these new regulations then? What kind of role can it play?
Well, look, the federal government's got a national target that it's accountable for, and electricity is playing a huge role in achieving those targets. So there is a role here. That being said, I think this point about shared jurisdiction is really important. We want, as a country, the provinces and federal government to be pulling in the same direction. There's lots of reasons why that makes sense for attracting capital, for keeping energy costs low over time. So the solution really seems to be more negotiations about exactly what is implemented. This is an initial proposal. There may be additional negotiations. It would make sense for Alberta and Saskatchewan to think about looking for more flexibility potentially, but really getting on board with this pathway to a competitive energy system that'll help them build an economy of the future.
We only have about 30 seconds left, but I do want to touch on Nova Scotia. You know, they've had pretty ambitious goals here. What can the rest of the country learn from them?
Interesting that Nova Scotia has said they're a willing partner in this process. They've responded differently to this federal policy than other provinces, yet they have some of the same challenges in their grid. I think that shows that there is an opportunity. The Atlantic provinces are working together on the Atlantic Loop to try to build a collective clean electricity system that can work together. All of that can contribute to lower cost energy. There's a reason why provinces are willing to pursue a collaborative approach here.
Thank you so much for your perspective today. That was Dale Buyugin. He's Vice President of the Canadian Climate Institute.
Well, it seems like bitterness is festering among senior Goldman Sachs partners over David Solomon's leadership as CEO, and they are pressing the president and the second in command to David Solomon, John Waldron, to pick sides. That's according to the latest report from Bloomberg's Sri Natarajan. Sri, thank you so much for being with us. You, as well as Shanali Basak, did some in-depth reporting about this meeting that took place between Goldman Partners and John Waldron. What did you learn?
Thanks for having me, Amber. And look, the meeting was obviously one very visible public sign of what is going on at Goldman. But what is true is it is becoming increasingly frequent to see these expressions of dissent inside Goldman Sachs. Doesn't always happen at a public setting like a steakhouse, but in various other conversations and meetings in and around the firm, this theme keeps coming up. There is dissatisfaction and disgruntlement over the ways of the CEO, David Solomon. But now there is a lot of focus on how his second in command, John Waldron, will act. Here's someone who's been the long-time deputy of David Solomon for more than 20 years at Goldman Sachs, and before that at Bear Stearns, while at the same time, he has to realize that he's the presumptive CEO in waiting, and is there a risk for his possibility to become the next CEO if he's tied too closely to the current leader?
And I think your article referenced, or could he become Gary Cohen, which you used as a verb? What could that mean?
It's important to understand that context as well. Gary Cohen was the longtime number 2 at Goldman Sachs. For over 10 years, he was the president at the firm, and he never became the CEO. Everyone assumed he would be the next CEO. Everyone thought he was the right guy in line, but it never happened. Lloyd Blankfein stayed on longer than perhaps Gary Cohen hoped for. Gary Cohen soon left for the White House for a good role, but he never became the CEO of Goldman Sachs. And it's not just at Goldman Sachs. If you look across corporate America and look at history, it is often hard for someone who is seen as the deputy, who is seen as the second in command, to suddenly be elevated and be respected as the new leader of a firm. And that is the thorny path ahead of John Waldron.
I think what struck me about your reporting is that how many people, even former Goldman Sachs people, you were able to get on the record. Again, uncommon, because at Goldman they value loyalty and privacy.
That is extremely true, but I think at this point there is no secret that there is dissatisfaction there. No one can hide behind the veil of secrecy and pretend that's not happening. The current executives are certainly talking about it, alumni are talking about it, and everyone in the industry is talking about it. Some of them perhaps watching on the sidelines with popcorn, and perhaps more concerning to the people inside the firm, because it is not just palace intrigue. They are truly concerned of what it means if it continues, if this level of bad publicity continues, what it means for the firm's franchise, for its brand, for its luster, and more realistically about its relationship with clients, which ultimately will impact its profits and their pay.
And I think it's important to understand, how much of this is gossip, perhaps discontent with a person and his management style versus actual performance, because under Solomon, Goldman Sachs shares have done well.
That is extremely important to highlight, because this is not your usual irritant of corporate woe because of lackluster performance or a firm that's being run into the ground. Anything but. Under David Solomon, the Goldman Sachs stock is up almost 50%. Their core investment bank has made great strides, has made progress with clients, has been growing stronger. So the question is, why is there dissatisfaction? And that goes back to the leadership style of David Solomon, some unnecessary and unpopular changes, and of course that misadventure in consumer banking that flamed out at just the wrong time, at a time of market downturn, which obviously had a big dent on profits and the mood at Goldman Sachs.
All right, thanks so much, Sri Natarajan, for breaking that down for us.
Attacks increase in their sophistication and their range, then the impact can be ever greater. There is a cyber attack on critical national infrastructure coming to a place near you within the next 5 to 10 years.
That was a clip from Billion Dollar Heist, a documentary feature from Universal Pictures that was released on various streaming platforms this week. It tells the story of the 2016 cyber raid on the central bank of Bangladesh, when hackers tried to siphon out $1 billion and actually made off with over 80 million before the attempt was detected and stopped, largely due to a fluke. The film highlights the cyber threats faced by financial institutions, corporations, and, well, anyone, as the world moves increasingly online. Eric Chin, fellow in the Security, Technology, and Response Division at Broadcom Symantec, is among the cybersecurity experts featured in Billion Dollar Heist, and he joins us now for more on this growing threat. Eric, thanks so much for making time for us today.
Thanks for having me.
So this documentary, based on these cyber criminals targeting this central bank back in 2016, so 7 years ago, how much has cybersecurity improved since then?
Well, we've seen some improvement for that specific case. In that case, they were trying to use the SWIFT system to transfer money between banks, and the SWIFT system realized that the weakest link allowed these attackers to potentially transfer $1 billion out of the New York Federal Reserve. So that's improved. But overall, the attackers are constantly shifting, constantly moving. So even though we continue to put in additional security hurdles, the attackers are always trying to one-up them, and it's a constant cat and mouse game, and it never ends.
So in this case, they went through the Bangladesh central bank, but they really had another target.
Yeah, ultimately, they were going after $1 billion that were held in the New York Federal Reserve on behalf of the Bank of Bangladesh, the central bank in Bangladesh. And ultimately, they were able to use the SWIFT system to move that money out from the Federal Reserve over to the Philippines.
And in terms of how this particular breach was detected, partly because of a misspelling of a name, Eric?
Yeah, I mean, actually, it didn't really go detected until the attackers sort of had finished. But the attackers only walked away with about 80 million instead of the 1 billion because of a typo. They had misspelled one of the recipient names. And because of that, that particular transaction was held for a moment. And they had logged out thinking that the New York Federal Reserve, the day was over, and they weren't likely to receive any more communication back. Had they waited maybe an hour, they might have gotten some of those notifications and then corrected them and said, oh, this was a typo, we corrected it, and then the money would have gone through.
Oh, that's so interesting. Okay, so in terms of sending money around the world, I mean, people do that all the time. How secure is it just for your average person to be sending money?
So your average person, if you're sending money to someone, that's relatively secure. The real issue is the person themselves getting tricked or scammed into sending money to someone or to an account that isn't the account they intend to send it to. We see this all the time where hackers will potentially get onto your system and actually change wire transfers that you have to different account numbers. And suddenly money that is intended to go to one place ends up going somewhere else.
Tell us about the extent of cyber threats these days. Just how common are cyber attacks? Can you even put a number on it?
It's constant, and it's in the order of billions of dollars for sure in regards to losses, and it's across the spectrum. It's everyone from your home user at home all the way to nation states, large corporations, and national critical infrastructure, which is some of our biggest worry today.
When you're hearing a lot about artificial intelligence these days, how do you think that could end up influencing things? I'm wondering, does it make the cyber attackers smarter or more capable of doing stuff and maybe of tricking people in order to, get them to be the weak link?
Yeah, absolutely. What we're seeing now with generative AI is it's making attackers more efficient. It isn't able to generate brand new novel attacks, but it is able to make their job easier. Fortunately, most of the security products out there, the security hurdles out there are designed to protect people against the most sophisticated attacks. And we're not seeing Gen AI sort of, raise the level of sophistication, only allowing attackers to make their job a bit more efficient and a bit easier. However, we see a future where generative AI can expand and these attackers potentially could automate their attacks end to end, making them very easy for them and making it easy for someone who knows nothing about computer systems to launch their own attack. On the flip side, this generative AI technology can also be used by security companies like here at Symantec. And we believe actually generative AI will give security companies an upper hand. We have much more money and compute power to put into generative AI than the attackers do.
So many of us put a lot of data out there into the world. Largely because companies are asking us for it. Maybe you're filling out some sort of a form or what have you. What could we be doing to protect ourselves better, do you think, Eric?
Yeah, there's a couple of things. So the first is always reducing what we call your attack surface. So doing exactly what you said, which is think twice about the types of data you're sharing. Are you sharing your location, that kind of information? And the second thing, which is probably the cheapest right now, and the thing that will give you the biggest bang for the buck, is to turn on what's called multi-factor authentication or two-factor authentication. It's the extra sort of number that you have to type in sometimes that's sent to your telephone before you can log into your account.
Yeah, that's that feature that Twitter now makes, or X now makes you pay for. That kind of got me. I thought it was a valuable one as well. Interesting that you think so too, Eric. Thanks so much for joining us today. We'll look forward to checking out the documentary and your role in it. Thanks so much for your time.
We're about 50 minutes away from the start of trading on this Friday morning. We want to get an update on some of the early movers in New York, and for that, we turn to Simone Foxman from the Bloomberg team, joining us from Bloomberg's headquarters. Simone, great to see you. I want to start with the story of Deere. This is a massive company, and at first glance, it's a bit of a head-scratcher when a company has better than expected results, but the stock is under some pressure. What's going on with Deere?
Yeah, that's right. I think there's this feeling among analysts, though, that this could be as good as it gets, even though the company lifting its financial its outlook for the fiscal year, even though it's seeing $9.75 to $10 billion profits, where it previously expected $9.25 to $9.5 billion. You know, what's happened with Deere is it was able to hike prices of its agricultural equipment, especially once we saw this Russian invasion of Ukraine that sent food prices, especially grain prices, through the roof, as there were really concerns about supply. But that has kind of mitigated. One of its chief rivals had also come out and said recently that it's limited in how much, in terms of price increases, that it continue to pass on. So even though we get this kind of positive returns, that's why we're seeing shares sinking in the pre-market.
Okay, that's helpful context. We'll keep tabs on Deere. You're also watching Estee Lauder, and you know, you think about beauty-related businesses, and they make a lot of money, and for a lot of years it felt like investors were gravitating towards this stock, but it has really struggled recently. We already this morning were talking about some of the uncertainty in China. There is an Asian component to the worry around the Estee Lauder business.
Yeah, that's right. I mean, the Asian part of the business is about a third of its overall sales. Yet Estee Lauder has had some problems in investing to support that business. If you look, there's an interesting statistic in one of our articles out wrapping what's happened to this company over the last couple of years. One of them was that in 2012, you know, it was about 20% of the business. There were 20% of the manufacturing capabilities in Asia. Now, though, those manufacturing capabilities are about 14% of its overall, even though the region comprises about a third of its sales. And the Asian consumer has been slower to recover, especially in China. And so therefore, Estee Lauder coming through with what Bernstein called strikingly weak outlook for next year, and that is not positive for shares this morning.
All right, and Simone, I do want to come back to the situation, the wildfires in Maui and the fallout from that, and we have seen that in real time in shares of Hawaiian Electric, which dropped precipitously this week, although there is a little bit of a bounce this morning. What do we know at this point?
Yeah, there were 8 straight days of declines in this stock, losing almost 68% through the last close. But this morning, 2 big factors. One, an investor update sent around by the company, emphasizing that they don't necessarily want to restructure. They intend to be in Maui for the long haul and through the rebuilding. They said they've restored power to about 80% of affected customers. There are still, however, 1,900 people without power in Maui. The other bit of news is that Jefferies is among the bond brokers out there trying to find someone who will buy the weird private placement, very rarely traded bonds of the company. Those are looking at a 40 to 60 cents on the dollar kind of valuation. But what this does signal is that investors, as well as the company itself, really trying to get a grip on exactly how much in terms of losses it's going to see. Of course, everyone very worried about the PG&E and California example. That company ultimately did file for bankruptcy back in 2019 after massive wildfires. And of course, nobody knows as yet how much Hawaiian Electric was truly responsible or at fault for not shutting off power ahead of these wildfires.
Yeah, trying to get those answers in real time. Simone, thanks very much. Appreciate the breakdown of some of those early movers.